This class is Financial Management. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I currently work as a chief economist and an adjunct professor of accounting and financial management. Today we will cover the second half of Chapter 7, Analysis of Financial Statements, from the excellent text by Brigham and Davis, Intermediate Financial Management. Now we will look at profitability ratios and ask questions like, what is the company's rate of return on its sales and on its assets? First, profit margins. The net profit margin is defined as the net income over sales. In our example, the net income is 253.6 out of total sales of 7,036 for a profit margin of 3.6%. Profit margins vary drastically from industry to industry. Grocery stores, for example, have a very low profit margin, whereas something like a jewelry store would have an extremely high profit margin. Another related ratio would be the operating profit margin, which would just look at earnings before interest and taxes over sales. This takes out things like how a company finances itself and how it manages its taxes. And this is 503 over 7036, or 7.1%. You would expect, of course, this to be higher than the regular profit margin. How about gross profit margin? Just the profit after you take out costs of goods sold, ignoring all of the other costs related to management, fixed costs, etc. And that's sales minus costs of goods sold over sales are 7,036. Again, all this stuff comes off of the earlier income statement, minus 5,800, the cost of goods sold over the sales of 7,036. For 1,236 over 7,036 are 17.6%. And again, you would expect this to be higher than the last two ratios. For this to mean anything, since there is a huge variation, for example, from grocery stores to jewelry stores, you have to look at profit margins versus the industry average. In the case of this company, it has been improving from 2014 to 2016, although 2015 was rough, and now the profit margin is up to the industry average. The same for the operating profit margin, which is now up to the industry average, and the gross profit margin, which is above the industry average. So they had a very bad year in 2015, but things seem to be looking a lot better. Other ratios you could look at would be basic earning power. So now we are looking at a rate of return off total assets, but again looking at earnings before interest and taxes to take out any issues with how the company is financed or how it manages its taxes. So BEP is earnings before interest and taxes, EBIT, over total assets are 502.6 over 3,517. Giving us a 14.3% basic earning power. This removes the effects of taxes and financial leverage. Useful for comparison, it is projected to be below the industry average and has been for the last several years, so there is certainly room for improvement. One of the most common asset ratios to look at is the return on assets, followed by the return on equity, which is net income over total assets. In this case, it is 253.6 over 3,517, or 7.2%. The difference between ROA and ROE is how leveraged a company is. For example, banks are like 90% leveraged, and many other companies, like software companies, don't have as much leverage. ROE is still higher than ROA, net income over common equity, 253.6 over 1977 of 12.8%. The only case where the two would be the same is if a company uses no leverage. If you see a company with a massively higher ROE than ROA, then that means they are taking on a lot of debt risk, which is certainly a problem today in financial markets with interest rates going up. In the case of this company, once again, it wasn't doing great in 2014. Both ROA and ROE were below the industry average. It got far worse in 2015 as the company lost money. It has improved, or is expected to improve, and estimates don't always turn out correctly, in 2016, but both the return on assets and return on equity are still below the industry average. So ROA is lowered by debt because there are interest payments that come out of net income. However, the use of debt lowers equity, and if equity is lowered more than net income, ROE would increase. As long as a company is making money, you would certainly expect ROE to be above ROA. But again, if companies are massively leveraged, like banks, for example, there is a lot of risk in that, and it can cause them to lose money. Of course, in the banking sector, usually those losses are passed on to the taxpayers. Now we will look at market value ratios, which are determined by how people investing in markets believe the future will behave. For example, if a company has a high current level of earnings and cash flows and people believe that will increase, then they will put a high P/E ratio on that company's stock. And if they believe there is a lot of risk and uncertainty in the future of that company, that will lower that P/E ratio. Similar things like the Federal Reserve setting interest rates at 0 will make P/E ratios very high, but when they raise interest rates, it should lower the P/E ratios. Here we how we calculate and appraise various ratios: price to earnings ratio, price to cash flow ratio, and market to book ratio. Consider a company with a stock price of $12.17. Its earnings per share is the net income over shares outstanding. In our example, there are 250 shares outstanding, and a net income of 253.6. So the earnings per share is $1.01. Therefore, the price to earnings ratio is 12.17 over $1.01, or 12, which is actually rather low by today's standards. For example, here is the Shiller price to earnings ratio for the S&P 500, and it is very highly elevated. We haven't seen prices this high except for the few years during the dot-com bubble. Perceptions of people investing in the market today are there must be a very high growth rate and interest rates are going to drop. If these things don't occur, then the odds are there will be another bear market and the price of the S&P 500 will drop. This has also affected the things like the automatic monthly investments of people's 401k plans into target date funds, which buy the S&P 500 and government debt, probably artificially increasing the value of those two investments. Another market-based ratio could be the price to cash flow. To get the cash flow per share, we would need to take net income, add back in depreciation since that is not a cash flow, and divide that by the shares outstanding. In our example, 253.6 plus 120 divided by 250 gives a cash flow per share of 149. Again, the stock price was $12.17. Divide by 149, and we get 8.2. Another ratio that could be looked at is book value per share. That would be common equity over shares outstanding. The amount of common equity in this company is 1,977 Again, shares outstanding is 250, and we get a book value per share of $7.91. The market price per share, again, we were told was 12. So you take 12.17 divided by 7.91, and you get a market over book ratio of 1.54. Today, again, in the market, stocks generally trade at a very high level. If you ended up with a company where its market value is below its book value, unless there was something wrong with the book value per share, then that company would be a breakup target. Stocks are so highly valued in the stock market today that is unlikely. We can again look at the S&P 500 in the United States as an example of how a price to book value could be evaluated. We see once again the valuations for the S&P 500 are extremely high, higher than seen since the dot-com bubble of 2000, indicating that participants in the U.S. stock market are very enthusiastic about the future performance of stocks, probably too enthusiastic, and that probably means they will underperform past years of investments in the market. So how do you interpret market-based ratios? Well, the price-to-earnings ratio is how much investors will pay for a dollar of earnings. From the point of view of the company, higher is better. For the investor, particularly if they are a value investor, lower might be better. Market to book, how much paid for a dollar a book. Again, from the point of view of the company selling the stock, higher is better. From the point of view of the investor, lower might be better. Price to earnings and market to book are high generally if ROE is high and risk is low. Of course, ROE being high could be due to high risk and high leverage. Once again, we can compare our company with the industry average. It was okay in 2014, but not great. It got really bad in 2015 and improved in 2016. In 2016, the price-to-earnings ratio is still below the industry average. Where they have done well is the price-to-cash flow, which has always been above the industry average, particularly in 2015. The market-to-book ratio is below the industry average. So while the price-to-cash flow has been good, the perceptions of people in the market generally are that this company is underperforming its industry peers since it has a low market-to-book value and a low price-to-earnings ratio. A way of comparing a company to other companies, since you have a large variety of different size companies to choose from in the stock market, are to compare yourselves to, if you are in management, you could use a common size balance sheet and divide all the items by total assets. So the company we are looking at, if we look 14, 15, and 16, all but 15, they had more cash on hand. Cash on hand makes you a safer company, but cash doesn't earn you interest, so it costs something, so that could lower your profitability. The short-term investments were much higher in 14 and have stayed much higher since then. Short-term investments are probably better than cash on hand since they earn you interest and they provide some security in a downturn. You can sell them easily to pay payroll, for example. Accounts receivable are above the industry average, but not tremendously so, and the accounts receivable is probably fine. Inventory is always above an industry average. That is costing the company money. They could perhaps approach more of a just-in-time system and try and lower the inventory on hand. So overall, their total current assets are higher than the industry average. That's probably not a good thing and could cut down on profitability. On the other hand, the net fixed assets are generally below the industry average. They have stayed so, and that means the company is probably managing its fixed assets very well, running shifts, for example, 24 hours a day in a factory. You can do the same thing with the liabilities and equity, dividing everything by the total assets. If we look at this comparing to the industry average, our company's accounts payable are somewhat below the industry average. They might want to increase that and get other companies to finance some of their operations, and that would cut down on the fact that they have such high notes payable compared to the industry average, and of course they have to pay interest on the notes payable. Perhaps they wouldn't on the accounts payable. Accruals are about the industry average, so the total current liabilities are well above the industry average, and that short-term debt increases risk and also forces them to pay interest. On the other hand, with the exception of in 2015, they've kept their long-term debt below the industry average. So this company has decided to finance with short-term debt, but not with long-term debt. That might lower interest overall, but increases risk. The total equity is below the industry average, but is anticipated improving in 2016. Of course, companies also always anticipate they're going to improve. So as an analysis of the common size balance sheet, Computron has a higher proportion of inventory and current assets than the industry. Computron has more equity than the industry, which means less debt, and Computron has more short-term debt than industry, but less long-term debt. You could also do the same thing with the income statement. You could do a common size income statement, in this case by dividing all items by sales. So the cost of goods sold for Computron is most of the time below the industry average, which is good. Their depreciation expense is high, which is probably fine. You get to write that off on your taxes. Their other expenses, on the other hand, are well above the industry average, and they need to engage in better expense control to make themselves competitive. Therefore, their earnings before interest and taxes has been below the industry average. Again, they project in 2016 they will improve, but projections don't always take place. Their interest expense has been above the industry average, which isn't good considering they are keeping more short-term debt than long-term debt, so higher interest expense and higher risk. They are projecting, once again, that this will go down to the industry average in 16, and therefore their pre-tax earnings will go up to right above the industry average. Projections don't always take place. Their taxes are anticipated to go up to the industry average as their profitability increases, and therefore they are anticipating their net income will go up to the industry average, whereas for the last few years it has been poor. So Computron has a lower cost of goods sold than the industry, but higher other expenses. The result is that Computron has similar EBIT as the industry, or at least is projected to have that in 2016. Another thing you can look at is the percentage change analysis. So we did a cross-sectional comparison with other companies. Now we are going to do a percentage change analysis of our own company. We are believing sales will continue to increase. We did an expansion in 2015. We increased sales, cost of goods sold, depreciation, and other expenses, so we lost money in 2015. But again, we are anticipating this expansion will make us profitable and compared to other companies in 2016, so we will get a massive increase in EBIT anticipated in 2016. This will then make us profitable, and we will go from a negative net income to a positive net income with a huge increase in earnings before tax, taxation, and net income in 2016. So we see that 2016 sales are projected to grow 105% from 2014, and then net income is projected to grow 188% from 2014. So they are projecting themselves to be profitable. Of course, a company will always say the future will be better, so invest with us. If we look at a percentage change balance sheet, again, looking at assets, we had cash going down in 2015 financing the expansion. We anticipate it going up in 2016, as with every other current asset going up drastically in 2016, and total assets are also going up drastically into 2016. We can do the same thing for the liabilities and equity side, looking at the percent change of that part of the balance sheet. Once again, you can see that the company is expanding rather drastically. Most of this expansion is financed by new equity, but some of it is certainly financed with new long-term and short-term debt, as well as an increase in accounts payable and accruals, which would occur automatically with an increasing company. If we compare the changes in the income statement with the balance sheet, we see that total assets are projected to grow by 139%, while sales are only projected to grow by 105%. So asset utilization, particularly with the short-term assets, remains a problem. Another relationship, a combination of various ratios that can be used to analyze a company, is the DuPont system, which focuses on splitting up return on equity into expense control, asset utilization, and debt utilization. So profit margin, total asset turnover, and the equity multiplier. It shows how these factors combine to determine the return on equity. So if we look at the DuPont equation here, we see ROE is net income over common equity, our net income over common equity. The sales cancel out and the total assets cancel out. But this allows us to split up and say, how is our company doing compared to other companies on profit margin, total asset turnover, and leverage? So in our example, first here, looking at the first column of profit margin, our net income over sales, we can see our company always is below the industry average, although it is projected in 2016 to get up to the industry average. It did poorly in 2014, even poorly in 2015, but they hope it gets better in 2016, and that is something they certainly need to focus on. The total asset turnover is always and is even projected to be below the industry average, and that is probably due to having too many current assets on hand, and they could increase their profitability by decreasing the assets necessary to support their sales. What the appropriate level of leverage is depends a lot from company to company and industry to industry. This company had higher leverage than the industry average in 14, way higher level in 15, but they are going to more equity financing in 16, which is at least a much safer way to finance their company. Their return on equity is always worse than the industry average, and while improving, is not expected to get that much better. I have other videos on the DuPont system using Excel, as well as many of the other ratios discussed in this chapter, particularly ROE and ROA, and their relationship to leverage, particularly in the banking sector. There are potential problems and limitations of ratio analysis. Comparison with industry average is difficult if the firm operates in many different divisions. A good example of this would be the company General Electric, which seemed to try and be a lot of different companies combined together. They finally had the sense to at least break that up into 3 companies this year, which should have been done a long time ago. You could also look at seasonal factors. Retail companies tend to do most of their business around the Christmas season. That can distort ratios throughout the year. Window dressing techniques are commonly used and can distort ratios. Companies, for example, always talk down their earnings and then beat them during earnings season, and actually reported earnings are generally quite a bit different than operating earnings, as companies always claim that all the bad stuff is a one-time event, but all the good stuff will continue. different accounting and operating practices between different companies, particularly looking from country to country, can distort comparisons. Other qualitative factors can affect the usefulness of ratios. There is greater risk, for example, if revenues are tied to a single customer. If that customer goes to somebody else, you're in trouble. Or to a single product. You could particularly imagine a company in the pharmaceutical industry and their one product is not yet approved by the FDA. Or in the defense industry when their only customer is the U.S. federal government. Reliance on a single supplier, particularly an overseas supplier, if you have disruptions in the supply chain, can be a major problem. Also, related to that, higher percentages of business generated overseas, again, creates more risk. So you have to look at things like what is the competitive situation in your industry, what products are in the pipeline, are you going to get a new drug approved by the FDA, is there going to be a new Apple iPhone that everyone will want, or will it be a dud? What are the legal and regulatory issues? Lots of companies get sued and can run into bankruptcy. Examples of this would be silicone breast implants and things like asbestos in brake pads, which, for example, bankrupted Dow Corning and Abex Corporation. I thank you for watching this video.